Hi friends, good morning. So we are going to start today with your revision batch of AFM. I'll keep it very simple. I'm not going to spend time on giving intro of the subject or anything. We'll directly move to the subject. We'll try to maximize the time which is available. So the objective is to maximize the time available. So I'll directly get into the subject. First, initial 3-4 minutes, I'll just discuss the paper pattern. Once the paper pattern part is discussed, I'll directly get into solving questions, discussing concepts. Objective would be over the next 12 to 13 days. I don't know how many hours I'm going to take. My last revision was for 50 hours. This revision, obviously, there is an add-on of capital budgeting, so it will increase. And I'm also planning to increase little bit the discussion, so maybe it goes to around 70 hours or 60 hours. I'm not able to comment as of now, but as we proceed we'll understand, depending on how you are able to respond, we'll see. And being a revision batch, the speed will be a little bit on the higher side, so I'll make it very clear that the speed is going to be on the higher side, but yes, with along with clarity, you will get all the concept clarity. Focus would be on getting clarity of the concept along with solving question. In our last batch of revision, we were able to solve 300 questions in around 50 hours. So that's the pace at which we work, and you will I'll ensure that you are getting full clarity on the subject. Let's first quickly discuss the paper pattern. As you are aware, your paper pattern has 30 marks of MCQ and 70 marks of descriptive. Now, MCQ doesn't need a separate preparation. That's the first thing I want to tell you. MCQ doesn't mean that you'll have to separately prepare for it, because what ICAI has done is, for your MCQ, they are testing the questions directly from your normal questions only. Just to give an example, this is your mock test paper question. This is a 8-mark normal practical question which a student will solve. You could have seen this question if you have gone through an area called security valuation. Now they have given this and then they've asked you 4 questions. These were 4 requirements of the problem. Now only thing, the add-on which has happened is now you have 4 choices also. What this does is, there are few places where I have to take an assumption. I may do some rounding off. All this headache is eliminated now, because if you do rounding off also, your answer, if you are getting 12.75 and you write 12.75, earlier ICA may award marks, may not award marks, but now 12.75 is not there, you will tick 12.77. So at least that headache gets removed for your 30 marks of the paper. MCQ doesn't need a separate preparation. This was a 8-mark exam question. This was also an 8-mark exam question earlier in mutual funds chapter. This was a question which you could have seen earlier. It is not something new for you. Or this question you would have seen in mergers and acquisitions. For maybe they'll ask you different calculations to be done, but again makes it very simple. This was a 8-mark question. So MCQ, first thing, doesn't need a separate preparation. Because someone is unmuted, can you please go on mute? Okay, first thing, MCQ doesn't need a separate preparation. Let's be very clear. That is something I want to make it very clear. Then why did I release an MCQ book? So I have released an MCQ book which has 900 plus question. The objective of the MCQ book, you'll understand as we proceed with the discussion. The objective of my MCQ book was not to answer MCQs, was to answer your descriptive question. So the MCQ book, if you have, someone has gone through the MCQ book, you will understand that the MCQ is going to test your concept clarity. MCQ is the best way of testing the clarity of concept. If somebody's concept clarity I want to test, the best way of testing that is only through multiple choice question, rather than trying to ask you questions. Come to the front row. Rather than asking questions, no, you also, rather than asking questions on the descriptive form, if I ask in MCQ form, I'll be able to test exactly the clarity on your concept. Internationally, most of the courses are in MCQ mode, like CFA, which is entirely MCQ mode. Take CPA, that has a lot of MCQ base. So guys, please don't so internationally, most of the courses are going to be in MCQ mode. So ICA has done the good thing of adding 30 marks of MCQ. Ideally, they should go to 70, that should go to 80, that should go to 100. That's the best way of testing, because you will keep hearing from the students, I wrote something, ICA did not award marks, I did this, I did that. All that headache is eliminated, at least for 30 marks of the paper, assuming they don't do any goof up in the MCQ question. If all that happens, that's a different thing. But in MCQ, if there is no goof up happening, at least 30 marks is taken care of. 30 marks of the paper is taken care of. Only thing which you need to know is if you are aware of the concept. For example, there's a concept called equivalent EPS. If you know the concept, you'll be able to answer this. You don't know the concept, no story, nothing, no steps, nothing needs to be done, 0 marks. Either 0 or full mark. It's a 2-mark question. You'll get 2 marks or you'll get 0 marks. So best way of testing your concept clarity is only through multiple choice question. So that's the first thing. So they have asked MCQ. Don't think that you need a separate preparation for multiple choice question. Guys, please don't unmute. Okay, so you don't need a separate preparation for multiple choice question. Let's be very, very clear on that. Why I want to make it very clear is because students somewhere think that they need to separately prepare for multiple choice question. First row. Somewhere need to prepare separately for multiple choice question. That does not exist. There is no separate preparation needed for multiple choice question. Let's be very clear. Not only my subject, be it any subject, MCQ, in fact, theoretical subject. Guys, I've been telling don't unmute. If you are not interested in the class, you can please exit the class. Whoever is facing this challenge, please exit the class. I cannot repeat this again now. I get into a flow, you guys keep disturbing it. Okay, so the importance of 30 marks is discussed to you, which is the multiple choice question discussion, where I'm telling you that you don't need a separate preparation. So my class, when I'm doing a question, I'm indirectly doing a 100-mark paper rather than doing a 70-mark paper. That's the first discussion. No separate preparation for MCQ. Then what did MCQ ended up doing? MCQ ended up doing that you cannot by heart your theory. You cannot by heart your theory, because earlier people were just by hearting and reproducing it in the exam. ICAI says that will not work. That is not going to work. For example, this is a question which is on an area called what is the criteria for bond selection. This is a theory question. This is a theory question called criteria for bond selection. What earlier student was doing is he was reading it, remembering it, reproducing it in exam. Reading, remembering and reproducing it in exam. ICAI says we don't like all this. You cannot just read and reproduce it in exam. So one part of the question, this is what I could observe from MTP1. As of now, I just have MTP1 in front of me. But my observations, I'm telling you from MTP1 that theory will be tested in exam. It will be tested like this. Along with that, they are also going to tell you that you need to by heart and reproduce also. You need to by heart and reproduce also in exam. That part is not eliminated. That part is not eliminated. If you remember in your earlier syllabus, every question used to have 4 or a 6 mark theory question. Now what ICAI has done, at least I'm talking only from mock test paper, in a 14 mark they're asking for 4 marks theory, but not in all questions. There were 6 questions in exam. In that 4 questions had a theory component, 2 questions fully practical. So net to summarize, I can say theory descriptive breakup, that is theory and practical breakup, is going to be 20-80. In this 20, descriptive and MCQ. Descriptive could be around 14 marks, MCQ could be around 6 marks, and balance 24 marks is MCQ in practical, and here you can say 80 minus 24, 56 is MCQ. So 56 is descriptive, where you will have to solve proper question and answer it. So theory will still come in exam. For example, if I look at the mock test paper, there are 4 questions of 4 marks. Assuming you answer question 1, 2, 3 and 5 and 6, you leave the 4 in choice. So still you will have to answer 3 into 4, 12 marks proper theory. Proper theory needs to be answered in exam. So theory is something which cannot be ignored. Still it will have a weightage of 20 marks. Earlier students were just remembering and reproducing it in exam. Now ICAI says we want you to do both. You will have to remember and reproduce also, and you will have to understand the concept also. Assuming you understand the concept and you are not able to reproduce as it is, you write in your own words, maybe you lose some marks here and there. That ICAI will not obviously award full marks if you write in your own wordings and all, but here that's one part of it. So of the 20 mark of theory, 6 to 8 marks can be MCQ, 12 to 14 marks can be your descriptive theory. To cut it short, theory cannot be ignored. For your theory discussion, there is a small material which would have been given to you, which is a 90-page material that is sufficient to cover the entire theory component. So don't come back to me saying that can you give me some important theory paper, all this. But I just go by past track record, and I can tell you in past track record, ICAI has asked theory more from chapter 1, chapter 2, chapter 7, chapter 15. 1, 2, I think, sorry, what is chapter 2? Just tell me, is it capital budgeting or risk management? Risk management. Okay, just give me a minute. Because the chapter numbers have undergone a change from your earlier syllabus to this. 1, 2, 4, 7, 15. 1, 2, 4, 7, 15. This is where predominant theory questions have come in exam. And even if you look at the entire 90-page material, these 5 chapters put together will take away 50-55 pages because they are theory heavy chapters. These are the theory heavy chapter. Chapter 1 is introduction, which is fully theory based. Chapter 2, risk management, small practical component, balances theory. Chapter 4, security analysis, predominantly theory based. Chapter 7, securitization, fully theory based. Chapter 15 is on startup finance, fully theory based. So 1, 7 and 15 full theory. 2 and 4 is 90% theory, 10% practical. So ICAI predominantly have been testing theory from 1, 2, 4, 7, 15, but they can give their surprise element. ICAI can keep giving surprise element and MCQ can come from anywhere. One thing from an exam point of view, whether you know MCQ, you don't know MCQ, because of no negative marks, you will have to anyway answer that. You will have to complete answering that, whether they give you, whether you understand it, you don't understand it, at least you will have to answer your MCQ part. One good part about 30 marks of the paper is now completely in your control, because you cannot say that ICAI awarded marks, I did this, I did that. All that is eliminated unless they goof up in the question. They ask a highly illogical question, I can't help it, but otherwise predominantly your paper is like this, where you have a 30 marks of MCQ which will have theory as well as practical, no separate preparation for multiple choice question. That's the first key takeaway I want to give you. When it comes to descriptive, it is 1 mandatory plus 4 out of 5. Everything is a 14 mark question. Everything is a 14 mark question. So 14 into 6 they will ask. You will have to answer 14 into 5. In that question, 1 is mandatory, and 2, 3, 4, 5, 6 will have one choice question. In that, your wish, you want to leave in choice the theory element question or the practical element question fully. But still, you cannot answer entire paper in practical. Entire paper in practical is not possible. In not your earlier syllabus, earlier to earlier when syllabus were there, ICAI used to do the same thing, but the last question was fully theory. The last question was fully theory, so people were leaving that in choice. Full theory question was left in choice. Now you cannot do that. You cannot do that, be it your earlier syllabus or this syllabus. The only good part I can say is, from a 20 mark by hearting the theory and reproducing, the number has gone down to maybe 12 marks or 14 marks, where you have to by heart and reproduce. Balance, you'll have to remember, well, not even remember, there's nothing remembering here. If you understand the concept, for example, I showed you this question. When you read the theory or when you solve the problems, you will learn about concept like yield to maturity, risk of default, tax shield, liquidity. All these are concepts. If you can understand what is tax shield, you'll be able to answer which is the right option. Or if you understand what is risk of default, you'll be able to answer which is the right option. So one part of the paper, ideally they should have, I would have been happy if they had avoided this direct theory question. If they had avoided the direct theory question and made it fully the concept testing theory, it would have been excellent, because that would have tested your ability. Because in practical world, you ask me what is sustainable growth rate, I'll tell you this is sustainable growth rate. You tell me write 10 lines about it, I'll Google and copy and give it to you. That is what I'm going to do in a practical world. So let's be very clear, in a practical world, I am not going to write some detailed line about what is sustainable growth rate. You want me to explain, I'll explain it. Explanation helps me in answering a multiple choice question. But you want me to reproduce exactly, I cannot reproduce exactly what ICAI has done. So if I also answer an exam, I'm also not going to get full marks as far as the theory part is concerned. But you don't have a choice. So don't tell me that you want to write in your own way. ICAI may not award marks. So for our exam purpose, we are very clear that we are going to read it, reproduce it, and then get the marks as far as the exam is concerned. So to cut it short, 20 marks is the theory component, 80 marks is the practical component. For the theory component, in my YouTube channel, there is a playlist called AFM Theory. There's a playlist called AFM Theory, where whatever that 90-page material you see, every chapter theory is discussed there. I've discussed little bit in detail this time. So you will find a AFM theory discussion playlist in my channel, which has 13 chapters as of now. 2 chapters are missing in it. Those 2 chapters, you see my earlier theory video. There was an earlier theory video which was given for old syllabus. The 2 chapters which are missing are not predominantly theory based. I have not covered Forex till now, but you can see the Forex earlier video. There were no add-ons there. So Forex has 2 separate chapters. One is a normal Forex and one is international financial management. Those theory chapters yet to be uploaded. So this covers, I think it will cover theory in around 10 to 12 hours maybe. It is a slightly lengthier discussion. Each chapter I may have discussed a little bit in detail. For example, the first chapter, security valuation, is around 1 hour 17 minutes. Mutual funds is around 46 minutes. Mergers is 41 minutes. So you will find all of that here. It is a slightly lengthier discussion. When you are watching it, if you are finding it is going at a slow pace, you watch it at 1.5x, 2x, whichever speed you want to watch, whatever is comfortable for you. That will help you in answering the MCQ part of it. That will help you in answering the MCQ part of it, and will also give you the clarity on the concept. Then you can just see how you want to reproduce it in exam. Also, as far as exam where you have to reproduce it, that is, you will have to write it exactly the same thing. There's a concept book which is given. I'll discuss what is concept book under later. In the concept book from page 209, you will find summary theory notes of every chapter, where every chapter may get over in 2 pages, 3 pages, something like that. So that 90 page may go down to around 30-40 pages. So this 30-40 pages can help you in answering not the practical theory question. For example, this is the MCQ which got tested. Criteria for bond selection. I said YTM, risk of default, tax shield, and liquidity. ICAI has given this as the choice. That's all. This summary theory will help you in case they ask what is the criteria for bond selection. You can remember these 4 points and then write it in exam. So this theory can help you in answering only the descriptive part of it. Can help you in answering the descriptive part of it. Can it help you in answering the MCQ part of it? Yes, provided you know what is YTM, what is risk of default, what is tax shield, what is liquidity. It can also help you in answering the MCQ part of it. But for that, you will have to understand all this. You cannot just be in saying that, okay, I'll just remember and reproduce, will not work. This can help you in answering both part of it. This is the last stage. When I say last stage, after you're done with your preparation, in order to quickly revise chapters, you can just go through this part of the theory, which is there in the concept book. There are 3 materials given to you. There's one called as a theory book, which covers the entire theory in around 90 pages. There's a concept book. I'll discuss about the concept book, the most important material for us. And there's a question bank which is given to you. So these are what is given. So I've discussed what you are going to do with the theory part. Any doubts what you need to do with the theory part, which is a 20-mark segment of the paper. Even in my normal class, I don't discuss theory. So obviously in my revision, I'm not going to directly discuss the theory, but I will tell you what you need to do as far as the theory part is concerned. Clear? Now we are going to move to the practical part of it. In practical, my objective would be to do almost all the chapters. Most important questions we'll try to do it. In that, I'm going to start with mutual funds. I'm going to start with the mutual funds chapter. You will have to keep shuffling between 2 books. There's a concept book and there's a question bank which is given to you. You will have to keep shuffling between these 2 books. Theory book will not be watching, will not be seeing the theory book. So I'll first discuss a broad overview of the mutual fund chapter. I'll discuss a broad overview of the mutual fund chapter, and then we start getting into certain key discussion. Now you start writing with me. Overview of mutual funds. Overview of mutual funds. Own return versus MF return. Own return versus MF return. Dividend reinvestment versus dividend payout plan. Reinvestment versus payout plan. Growth, bonus and dividend scheme. Growth, bonus and dividend scheme. Holding period return and annual return. Holding period return and annual return. Holding period return and annual return. uh, then NAV calculation, NAV calculation, reverse working, reverse working, reverse working, MF performance evaluation. This is a broad category. There are certain miscellaneous areas which I'll keep adding on. There are certain miscellaneous discussion which could be needed, but this is a broad overview of the mutual fund chapter. Now, I'll first quickly discuss what is a mutual fund, just 1 minute discussion to understand a mutual fund, and then we get into the clear discussion. So, what a mutual fund does is, when I am sick, I need to go to a doctor, he will look at me and then give a treatment. Similarly, if you are having money and you don't have the knowledge of investing the money, when you don't have the knowledge of investing the money, you can give this money to a mutual fund manager and he will take care of managing money on your behalf. This is a simple definition of a mutual fund. Mutual fund is going to collect money from a lot of investors and invest the money on behalf of so many investors as per the scheme. There is a scheme which will say, the scheme may say that you want to invest in debt, you may want to invest in equity, you may want to invest in debt and equity, hybrid investment, gold, whatever is the scheme saying. So what a mutual fund does is, he collects money, invest it, earn return. Whatever return he earns, in that he will meet his expenses. There are various expenses which he needs to incur, and the net amount will go to the mutual fund investor. The net amount will go to the MF investor. This is what broadly a mutual fund manager does. He collects money, he has to meet his expenses. He will have expenses like your infrastructure expenses, software expenses, his salary, employee salary, some variable pay, all that will be there. He removes that. That is technically called expense ratio. That's technically called expense ratio. The net amount would be paid to the investor. This is what the role of a MF is all about. In the context of this, let's start seeing certain concepts related to it. Page 90, concept book, page 90, chapter 8, mutual funds. MF return versus individual return. Okay, in fact, the summary is here itself. I need not have given. MF return versus the individual return. Now, when I was explaining, I told the mutual fund will incur, earn 14%, but he will pass on only 10% or 12% to it, because he has to incur his expenses. He has to incur his expenses. So, the mutual fund cannot give you everything. In this segment, what we are analyzing is, I on my own can earn 14% return. If the mutual fund also earns 14, he cannot give me 14. If the mutual fund also earns 14, he cannot give me 14. He can give me only 12, 10, because the mutual fund has to meet his expenses. The mutual fund has to meet his expenses. So in this concept, we are going to link how much should the mutual fund earn so that he can give me a return which I want. He can give me a return which I want. So the formula is MF return is equal to own return divided by 1 minus initial expense ratio plus the annual expense ratio. I'll give the logic of the formula. The mutual fund, what happens is, when you start a mutual fund, he has to incur certain expenses. That is called initial expense ratio. So if you give 100 and you want to earn 14 on this, mutual fund is saying, no, I get only 98 from you. I get only 98 from you. On 98, I'll earn you 14 rupees. On 98, I will earn you 14 rupees. On 100, I cannot earn 14 rupees. So on 98, 14 divided by 98 is how much? 14 divided by 98 into 100. 14.28. So basic logic is, if you earn 14% on 100, you can give 14% to the investor. But he is saying, I gave you 100, you got only 98. So don't earn me 14 on 100, you earn 14 on 98. How does it 98 comes? Own return 14 divided by 1 minus the initial expense. 100 minus 2, 2% is the initial expense. So that is subtracted in the denominator. Along with that, I also need to take care of my regular expenses. I need to take care of my regular expenses. If I'm able to take care of my regular expenses, then I'll be able to meet the mutual fund or the investors return. Then I'll be able to meet the investors return. So an investor wants certain return. I can earn that return only by earning more than 14%. I can earn that return only by earning more than 14%. Second concept, MF return versus individual return. This is tested in question number 3. This is tested in question number 3. But I'll discuss it first. I'll discuss it what happens. See, when you want to invest on your own, you can earn 12% return, 14% return, all that is good. But who will take care of the time element? Because when you invest on your own, you need to do certain research. You need to do extra research. So, though investing on our own is beneficial, but there is an opportunity cost. There is an opportunity cost element when you invest on your own. See, earning 12% through mutual fund could be better than getting 15% through own investment, because that extra 3% you are getting, you wasted the entire day. You wasted the entire day. So there is a value which needs to be attached for your time. There is a value which needs to be attached for your time. MF may give you 12 or 10 and you on your own can get 20%. Maybe 10 is better than 20. Maybe, I'm not saying it's always, but maybe 10 is better than 20. Let's assume I have a portfolio of 1 lakh rupee. If I earn extra 10% on that, extra 10,000. Instead of doing that, if I had taken one more batch of classes, I could have earned extra 50,000 rupees. So obviously this is better than me investing on my own and earning that extra 10%. So this is what is getting tested in this concept. Let's understand this with an example. Mr. X can earn 15% on own. Mr. X can earn 15% on own. The MF will give him only 13%. So straight hit of 2%. I'm going to lose 2%. The MF will give him 13%. This is after meeting their expenses. Okay. This is not what MF is earning. MF could be earning 14, 15, 16%. They are giving you 13%. They are giving you 13%. But if you do your own investment, if you just stop at this stage, I'll say please do own investment. Please do own investment, because own is 15%. MF is giving only 13%. I have a portfolio of how much? 100 lakh. So if I give to mutual fund, I lose 2 lakh rupees. 2% on 100 lakh. 2% on 100 lakh. I'm losing 2 lakh rupees if I tell MF to invest. If I tell MF to invest, then Mr. X is a chartered accountant, currently earning professional income of 45 lakhs. Mr. X is spending 10% of his time. Let's assume he works for 10 hours a day. In that 1 hour he is giving for market, 9 hours he is giving for his profession. If he spends this time on profession, his professional income will increase proportionately. His professional income is going to increase proportionately. Now, what is the conclusion of this? With 90% of my time, I earned 45 lakhs. With 90% of my time, I earned 45 lakhs. If I give 100% of my time, if I give 100% of my time, I'll earn more. I will earn more. So if I give 100% of my time to my CA profession, if I give 100% of my time to CA profession, 90 is equal to 45. What is 100? So investing on own has a benefit of 2 lakh and an opportunity cost of 5 lakh. Has a benefit of 2 lakh and an opportunity cost of 5 lakh. Assuming I was idle, then I have no problem. But here I'm losing 5 lakh. Now what they are saying, what is the net gain or loss by investing in MF? By investing in MF, I will earn extra 3 lakh. I will earn extra 3 lakh. What is the extra 3 lakh? I earn 5 lakh of professional income and lose 2 lakh of investment income. I'm okay with it. I'm very happy with this. Let's go ahead and do it. So there is a net gain of 3 lakh. The third concept is holding period return versus annual return. You can mark question 4 and 5. Question 4 will be solving few questions. 4 and 5 is tested in this concept. Let me first discuss what is holding period return, what is annual return. Now let's first understand what is return. Return is nothing but what I get back minus what I give divided by what I give. That is the formula for return. Let's understand anything. For example, I ask my father, give me 1 lakh rupee, and his next question will be, what will you give back? Assuming it's for an investment purpose. I say you give me 1 lakh, I'll give you back 1 lakh 20. His mind has done the calculation. 20,000 is return. 20,000 is the return. So return is nothing but what you give back minus what I invest. So the real formula for return is what I get back minus what I give, what I get back minus what I give, divided by what I give, divided by what I give. You gave me 1 lakh rupee, I gave you back 1,10,000. What is the return you earned? 10%. You have earned a 10% return. You gave me 1 lakh, I gave you back 1,10,000. You earned a return of 10%. You gave me 1 lakh, I gave you back 1,10,000 in 6 months. In 6 months, what is the annual return you earned? I gave you back in 6 months. What is the annual return you earned? 10% per 6 months, 10% per 6 months, 20% per annum, 20% per annum. So for doing annual return, you have to do into 12 by m. For doing annual return, you will have to do into 12 by m. Without 12 by m, if you do, that is normal return, which is called holding period return. Practically anything more than a year, they normally calculate annual return. Anything less than a year, they normally leave it as holding period return. Problem may tell you to do anything. Problem may tell you to do anything. Now let's explain the formula. What I get back by investing in mutual fund is NAV1. That is the NAV at the end of the period. NAV at the end of the period, not NAV at the end of the year. NAV1 is NAV at the end of the period. The period could be 1 month, period could be 1 day, the period could be 2 years, 3 years, 4 years. NAV1 basically means closing NAV. NAV1 means closing NAV. So what I get back is NAV1, D1, which is called dividend, and CG1, which is called capital gain 1. CG1, practically there's nothing like D1 and CG1. Both are dividend only. Both are dividend only. D1 means dividend paid out of the dividends. Dividend paid out of the dividends. CG1 means dividend paid out of the capital gain. Dividend paid out of the capital gain. Both are dividends only. Both are, in fact, in practical world, I have not seen something like CG1. So both are dividends only. So what we are trying to do is we are saying NAV1 minus NAV0. What is NAV0? What I get back is NAV1, D1, CG1. What I give is NAV0. What I give is NAV0 divided by NAV0 into 100. If you do, that's called holding period return. That's called holding period return. If you do into 12 by m, if you do into 12 by m, that is called annualized return. Let's understand this concept. Opening NAV 20 rupees. Opening NAV 20 rupees. Keep focusing on the concept book. I'll solve problems also along with that. Opening NAV 20. Closing NAV at the end of month 3 is 21. At the end of month 3 is 21. Dividend paid in month 1, 2 rupees. Paid in month 2, 50 paise. Dividend declared but not yet paid. Doesn't matter whether you have given me dividend or not. That's my income. That is my income. The moment you have declared, it is my income. What is the annualized return? Annualized return means you'll have to do into 12 by m. Annualized return means you'll have to do 12 by m. Let's quickly do now. The concept book discussion, no need to write, okay? Practical solving alone, you write along with me. So what is the closing NAV? 21. Opening, dividend all put together. Capital gain. Capital gain is not 21 minus 20. That's capital appreciation. That is capital appreciation. What is capital gain? Is dividends paid out of the capital gain by the mutual fund. Whole divided by what is the opening NAV? 20. What have they asked? Annual return. They have asked annual return. So into 12 by how many months? 3 into 100. If you have understood this, you have understood the concept. If you have understood this, the concept clarity is there. So that is the purpose of the concept book and that is the purpose of the MCQ. I told the formula is NAV1 minus NAV0 plus D1 plus CG1 whole divided by NAV0 into 12 by m into 100. This is the formula we are following. Practically what happens is when you invest in a mutual fund, you can enter and exit at any time. You can enter and exit at any time. Today you want to buy the mutual fund. Evening you want to exit, you can exit. That is tomorrow you want to exit, you can exit it. Certain loads will be there, entry, exit load and all. But you can enter and exit at any time. That is called an open-ended scheme. That's called an open-ended scheme. There's another scheme called close-ended scheme where MF is saying don't keep disturbing me multiple times. You enter once, exit only after 3 years, 4 years, 5 years. So in a close-ended scheme, SEBI has made mandatory that you will have to list your mutual fund. You have to list your mutual fund. Why is listing needed? You bought the mutual fund today. After 5 days, you want to sell it. Mutual fund will not buy it back from you. Mutual fund is not going to buy it back. So you can go to the market, you sell it, someone else will buy it. Now the problem with this approach is when there is a listing which has happened, NAV1 could be at 20 rupees. But in the market, it could trade at 20.40 or 19.60. Some variation can be there in the value. NAV is the real worth. I'll discuss about NAV as we proceed, but NAV is the real worth of a mutual fund. But in the market, it could be trading at slightly more or at slightly less, slightly more or slightly less. So when you are calculating the return for a close-ended scheme, formula is NAV1 minus NAV0, but that NAV1 can be more than 20 or less than 20, can be more than 20 or less than 20, because when trading happens, you will see the price either on the higher side or on the lower side. Both ways it can change. Both ways it can change. Let's see an example. NAV on 1/1/2014 is 10 rupees. NAV on 31/12/2014 is 12 rupees. So 10 rupees is the NAV, 12 rupees is the closing NAV. Dividend and capital gain is 50 paise and 1 rupee 50 paise. On 31/12/2014, the unit was trading at what? Mutual fund is saying value is 12 rupees, but market is saying I will not give 12, I will give 2% less. I will give 2% less because the market trading is happening at 2% less. On 1/1/2014, it was trading at 2% premium. So when I entered into the mutual fund, I did not pay 10 rupees. How much I would have paid when I entered? 10.2. And when I exited, I did not get 12 rupees. How much I would have got? Discount 11.76. In the formula, don't use 10 and 12, use 10.2 and 11.76. Use 10.2 and 11.76. That is what a close-ended scheme is. In a close-ended scheme, the headache is because it is traded in the market. It is traded in the market. This is unfortunately leading to a challenge for me. This is unfortunately leading to a challenge for me. What is the challenge it is leading? In the market, because there is a buying and selling which is happening, the MF is not quoting at the real value. The MF is not quoting at the real value. It can quote slightly more or slightly less. Apply the formula and tell me. Use 10.2 and 11.76. Use 10.2 and 11.76. That is NAV1 is 11.76 minus 10.2 plus 2 rupees dividend divided by 10.2 into 100. 12 by M is 12 by 12 only. 1 year only is this. What's the answer you get? 34.9%. Clear? Let's go to the next concept. Okay. This is not a very big concept, but this is something which has led to loss of marks for many students in exam. ICAI will ask you to calculate something called as return. In return, we do 12 by M. Wherever the date of investment is available, ICAI has done 365 by D. 365 by number of days. And whether you have followed it or not, in the latest attempt, this was a major concern for many students and many lost marks because of this. So days versus months computation, nothing related from a practical point of view. It is more related to the questions which I have to solve. Nothing related to the practical part. I will see this concept in question 15. I'll see this concept. I'm not solving 15 now. I'll see later. Question 15 is where I'll see this concept. But days versus months calculation will make a difference. Wherever the date of investment is available and period is less than a year. Please do calculation as 365 by D and not do it as 12 by M. It will be exact 3 months, but ICAI will do 365 by 91. Some variation will be there in the answer. Unfortunately, they have not awarded marks. To students for that. Clear? Total yield of investor. What is total yield of investor? Again, this you can mark question 16. We'll do 16 later. I'm first discussing the concept because 15, 16 are lengthy questions. I'll discuss because data has 2-3 concepts related. What is total yield is? You have invested in mutual fund X. You have invested in mutual fund Y. You have invested in mutual fund Z. You want to calculate return for X, NAV1 minus NAV0 plus D1 plus CG1 divided by NAV0 into 12 by M into 100. You can calculate X separately. You can calculate Y separately. You can calculate Z separately. When you club them together, you cannot add percentages. First, you'll have to add the amounts. And then finally calculate the return. So total yield or total return is the combined return of multiple mutual funds. Let's take the example. I did an initial investment of 2 lakh, 5 lakh and 4 lakh in MFX, MFY and MFZ. In MFX, I earned a capital gain of 10,000. I earned a dividend of 6,000. What is capital gain? Is NAV1 minus NAV0. NAV1 minus NAV0. So this is not capital gain distribution. Okay, capital gain. Okay, whichever way you want to take it, it's capital gain distribution or capital appreciation, doesn't really matter. But these two are the returns for me: capital gain and dividend. What is the return of MFX? Can you tell me what is the return of mutual fund X here? Return of mutual fund X. 8%. You cannot say whether that is holding period or annualized because I don't know the period. I don't know the period. I cannot do into 12 by M. 8% for MFX. MFY. Negative how much? Negative. Calculate, please, guys. Negative 3.8. MFZ. So MFX, MFY and MFZ. MFX gave 8%. MFY gave negative 3.8%. MFZ gave 8. You cannot add all the three and say that the mutual fund overall gave this much return. So if you want overall return, first add all the three capital gain, add all the three dividend, and then divide by all the three investment. Divide by all the three investment. 2.64%. 2.64%. You will see this in a question later on. You will see this in a question later on. I'll want to first discuss the concept. Clear? Any doubts on this? So you can calculate return for X separately, Y separately, Z separately. But if you want a total yield, add the, you cannot add percentages. You cannot add percentages. Let's be very, very clear. Don't say 8 plus 8 minus 3.8. All that is not going to work. Clear? Next, period of holding calculation, tested in question number 16. Again, question 16. First, let me discuss it. What is this period of holding? If you want, you can move from, let's assume I generated holding period return of 8% per month. Can you tell me what is the annual return? 96% per annum. Now, question does not say 8% per month. Question say holding period return is 8%. Annual return is 96%. Holding period return is 8%. Annual return is 96%. I want to know what is the period of investment. So simple. 96% equal to 365 days. If I want to do days calculation. If I want to do days calculation. 8% equal to question mark. 8% equal to question mark. That will tell you 1 month. That will give the number as 1 month. So the question can give you, this was tested in one of the exam, reverse working. In reverse working they test. I'll explain with one more example. Annual return 85%. Holding period 25%. Can you tell me what is the period of investment? Annual 85, holding period 25. What is the period of investment? 100? Okay. So 85 is equal to 365 days. 25 is equal to question mark, which is nothing but 25 divided by 85 into 365. 25 divided by 85 into 365. This will give you the period of holding. Again, I'll test this in a question in some time, because let me first, because the question which I want to do has 3-4 concepts. Clear? Any doubts on this? An example here, period of holding is given. See, this example you see it later. Next comes dividend payout versus dividend reinvestment, an extremely important area. What is dividend payout versus dividend reinvestment? Is when you invest in mutual fund, you can say question number 6 for this concept. Question number 6 is there. Dividend payout and dividend reinvestment. Let me first discuss. Payout means I'm giving you the dividend. Payout means I'm giving you the dividend. Apply formula NAV1 minus NAV0 plus D1 plus CG1 divided by NAV0 into do 12 by M into do into 100, or do without 12 by M. That's your wish. Without 12 by M will give you holding period return. With 12 by M will give you annual return. What is dividend reinvestment? Is mutual fund declares dividend. Let's assume you have 1000 units. Face value of this is 10 rupees. NAV is 20 rupees. Okay, NAV is today 20 rupees. Mutual fund declared dividend. Mutual fund declared dividend. They said we are giving a dividend of 10%. We are giving a dividend of 10%. Any dividend is on face value. Any dividend is on face value. So mutual fund is now saying 1000 units into 1 rupee I'll give you. 1000 units into 1 rupee. So dividend in rupees is 1000. What I told the mutual fund is, you give me the dividend, I give you back this, I give you back this, and you give me extra units. You give me extra units. So there will be a reinvestment NAV given. So when dividend was declared, let's assume the NAV is 25. The NAV is 25. So I will not get dividend. I'll get 1000 divided by 25. I'll get 1000 divided by 25. Now the problem with this is, I cannot use NAV1 minus NAV0 formula because I don't get any dividend. I don't get any dividend. Another headache is NAV1 is for 1500 units. NAV0 could be only for 1000 units because you are getting extra units. You are getting extra units. So what formula should I use? Simple. What I get back minus what I invest divided by what I invest. What I get back, closing units into closing NAV. Closing units into closing NAV is what you get back. What you invest, opening units into opening NAV. Opening units into opening NAV divided by what you give, opening units into opening NAV. Per unit calculation will not work. Per unit calculation will not work. Mr. X invested 1 lakh. Invested 1 lakh when NAV was 10 per unit. The fund declared income distribution of 2 per unit and capital gain distribution of 3 per unit. When I purchased, how many units did I get? 1 lakh divided by 10. 1 lakh divided by 10. I got 10,000 units. What MF said is 2 rupees and 3 rupees. 2 rupees and 3 rupees. So MF is giving 10,000 into 5. What I tell MF is, don't give me this. Don't give me this. Give me extra units. Give me extra units. MF is saying, okay, we'll give you extra units. But that extra units will be given at an NAV of 20. That extra units will be given at an NAV of 20. So 50,000 divided by 20 is how much? So I originally had 10,000. I get another 2,500. Now they are asking what is the rate of return earned by the investor. Closing units is 12,500. Closing units is 12,500 into 30. 12,500 into 30. Opening units is 10,000 into 10. Opening units is 10,000 into 10. So my return is 275%. My return is 275%. With this, the problem is almost over, but still I want to practice one question, but the question is done. This is what I'm going to do in the question also, but this is what the concept is all about. ICAI has added something extra here and there, but this is the real concept. Real concept is, I don't want dividend. I don't want dividend. You gave me dividend. I gave you back dividend. You gave me units. That is what is happening here. That is what is happening here. Clear? Any doubts on this? Computation of closing units. Now, this computation of closing units is a slightly tricky calculation. There are 3 types of schemes I said. Be in listen mode, okay? There are 3 types of scheme. One is a growth plan. In a growth plan, what happens is, you invest one amount, you get 1 units, and that remains same. That remains same. There is no change in the number of units allotted. No change in the number of units allotted to you. If you have invested 10,000 units, you will get only 10,000 units in the end. That is called growth plan. Dividend reinvestment, I have already explained you, saying that the units can keep changing. And there's a bonus plan. In bonus plan also, I'll keep giving extra dividend, extra units. I'll keep giving extra units. Is there any difference in the 3? Practically no difference, because your closing units into closing value will take care of it. For in a growth plan, the NAV will be the highest and the number of units will be the lowest. In a dividend reinvestment, NAV will be in between. Units will also be in between. And in the last plan, which is the bonus plan, NAV will be the lowest and number of units will be the highest. So technically it doesn't make any difference. Doesn't make any difference. But there are 3 types of plans which are there. Now, how I do the closing units calculation? Dividend reinvestment plan. If you have only 1 dividend reinvestment like we did, I can do it that way. But otherwise, I'll prefer doing it this way. We'll see problems where there will be 10 dividend reinvestment or 15 dividend, sorry, not 10 dividend, 3-4 dividend reinvestment. 3, 4, 5 times dividend reinvestment could be there in a question. So we'll start with date, opening units. Opening units, there will be a dividend percentage. There will be a dividend percentage. Apply that percentage on face value. Apply that percentage on face value and then get the dividend in rupees. Get the dividend in rupees. There will be a reinvestment NAV given. Get the dividend in units. Get the dividend in units. Opening units plus the new units is the closing units, which will go to the next period. Which will go to the next period. They will give you some 4-5 dividend rates. 4-5 dividend rates. This is dividend reinvestment. This is dividend reinvestment, where you will start with the date. There's a unit held given in the question. Then there's a percentage, dividend in rupees, reinvestment in NAV, dividend in units, and the closing. You can keep doing the cycle again and again. Bonus plan, again you will start with the date. There is going to be an opening units. There will be a bonus ratio. There will be a bonus ratio. Based on this ratio, bonus units will be allotted and you will get the closing units. You will get the closing units. Just to give an example, Mr. X invested 1 lakh. Invested 1 lakh when the NAV is 20 and face value is 10. Face value is only for dividend. Face value is only for dividend. How many units will I get? Depends on the NAV. How many units I'll get? Depends on the NAV. There was one exam problem where I was doing a new public offer, an IPO or a new fund offer, where they did not give the issue price, If nothing is given, I can take face value. If you have given me an NAV on the date of issue, that will only give me the number of units. So 1 lakh divided by what? 20. That is my opening units. MF declared dividend of how much? 20% on 1/4/2011. So 20% into 5,000. 20% into 5,000 into face value. 20% into 5,000 into face value. I reinvested this at the rate of 25. My closing units became 5,400. Next period, copy paste 5,400. Now you are paying a dividend of 50% on face value. You get 27,000. Again reinvest. And now your closing is 5,940. You can keep doing this multiple times. Moment you understand this MCQ, this concept is over. Moment you understood the MCQ, the concept is over. That is why for revision only this is sufficient, I have told. Next comes this example. I invested 1 lakh when NAV is 25. 1 lakh divided by 25 is how much? 4,000. We declared a bonus of 1:4. So 4,000 into 1/4. Extra 1,000. Now it became 5,000. Then you did 1:5. Which is another extra 1,000. Now it became 6,000. Then you did 2:5, which is extra 2,400. So how many units will you have? 8,400. This is tested in question 8. Computation of closing units, question 8. I'll be doing 8 in some time. It's a very lengthy question. Okay, taxation impact. When I do this is nothing useful from an FM point of view, from an AFM point of view, but in exam when you do mutual fund calculation, there will be some capital gain, capital loss which will come. Long-term capital gain, long-term capital loss. You could remember that question if you have already gone through the material. So when you calculate your capital gain or capital loss, cost of acquisition of bonus units, there will be some bonus units. For them the cost of acquisition will be 0. For calculating your capital gain or capital loss, the purchase price of bonus units will be 0. Second, securities transaction tax is not a deductible expense for computing capital gain. This you would have anyway learnt in income tax. Securities transaction tax, when you calculate your taxable capital gain, is not allowed as a deduction. I'm going to do that question now. One good part in that question is only STCG was taxable. Practically now LTCG as well as STCG both are taxable. It can involve more calculation. But point is, if you have to calculate capital gain, you know how to calculate capital gain in income tax. In that, I'm just telling for solving here, don't subtract securities transaction tax. And for bonus units, cost of acquisition is 0. Clear? Any doubts on this? Effective yield which we calculate, we do 12 by M. No, that is not the right way of calculating effective yield. This is more from a practical point of view. Ideally, if you want to calculate return, you should calculate through IRR approach. approach. You should not calculate through. So this is just an example for IRR approach. Nothing much matters for you because in exam you're not going to present. In exam you're not going to present. For example, the sum we did, month 0 I invested 1 lakh. Month 124 I got back this much. Calculate IRR. Calculate IRR. If I show in Excel, the IRR will be 23-24% only. And we said the answer is 70%. We said the answer is 70% because that ignores time value of money. Moment you go beyond a year, time value of money is very, very critical. So we are ignoring time value of money in the calculation. But if you consider time value of money, IRR is the right approach. Okay, there's something called as a front end load and a back end load. Let me first explain what are these two terms. A front end load is otherwise called as entry load. A front end load is otherwise called as entry load, which Association of Mutual Funds of India has already abolished in 2009. Association of Mutual Funds of India has already abolished something called as front end load. But maybe we are learning concept of FM not only for India, it's in the context of global. So front end load question had come once in exam. So front end load is an entry load. What is entry load is? NAV is 10 rupees. NAV is 10 rupees, but you have to pay 10 rupees 20 paise. You have to pay 10 rupees 20 paise. That extra 20 paise, that extra 20 paise is front end load. That extra 20 paise is front end load. Assume you want to exit today. You want to exit today. NAV is 10 rupees, but I will give you only 9 rupees 70 paise. I'll give you only 9 rupees 70 paise. That balance 30 paise is exit load. The balance 30 paise is exit load. There is an entry load as well as there is a exit load. Entry load is the front end load and exit load is the back end load. Exit load is the back end load. This we are going to see in question number 12. Question 12. I'll directly do the question. Again, I'll first repeat. There's a formula. Don't look at the formula and all. Don't look at the formula. But logic is simple. NAV today is 20 rupees. You have to pay 20 rupees 50 paise. Extra 50 paise is front end load. Extra 50 paise is front end load. You want to exit, I'll pay you only 19 rupees. I'll pay you only 19 rupees, 1 rupees exit load. But you'll have to express in percentage. For expressing in percentage, ICAI gives two answers. They've given both are okay. For example, you said 50 paise is the front end load. This 50 can be divided by 20 rupees. This 50 can also be divided by 20.5. 50 can be divided by 20. To me, more logical is 20. To me, more logical is 20. But ICAI has given both answer. ICAI has given both answer. You can, when you want to express in percentage, you can divide by 20. You can also divide by 20.5. Similarly, for back end load, you can divide by 20 or 19. 20 or 19. I'll be dividing both by 20 only. I'll be dividing both by 20 in my answer. In my answer, but ICAI has given both the answers. They have given both the answer. Let's see this now. Okay. Concept 13. Let me first explain it. Again, I'll be discussing this in some other question. You can note down the question where we will discuss this. Question 16. Exit load versus lower return from mutual fund. Let me first explain it. You have invested in mutual fund X. You have invested in mutual fund Y. You have invested in mutual fund Z. X has given you negative 20% return. Y has given you positive 10% return. Z has given you positive 20% return. If I am smart and question says that in future same will repeat. In future same is going to repeat. I'll sell X. I'll sell Y. Put everything in Z. Put everything in Z. But there is one problem. The problem is there is an exit load. There is an exit load which is worrying me. There's an exit load which is worrying me because I have to see whether I have to incur that exit load or not. I'll again explain. Mutual fund X gave negative 5% return. Y gave positive 10% return. Z gave positive 20% return. So I did the math and I found X, let's close it. Y, let's close it. Z, let's shift. But there's a headache. The headache is exit load. The headache is exit load. Exit load is something which mutual fund cannot charge always. There is a time period. Most of the mutual fund will say if you exit before 1 year, we'll charge you exit load. Otherwise, they will not charge exit load. So here I need to see whether I need to wait and incur that loss in return or incur that exit load. If you leave immediately, you'll incur exit load and earn extra return. Incur exit load and earn extra return. If you wait, you will save on exit load but earn lower return. Earn lower return. Which is better? I have to analyze. Which is better? I have to analyze. Let's understand this. An individual invested in mutual fund might come across a fresh purchasing opportunity which gives better returns. Nonetheless, the MF investor could potentially incur an exit load if they choose to exit their investment prematurely. In this situation, I have to do the comparison of exit load with the potential loss in returns. An example, MFX gave 9.733% return. MFX gave 9.733% return. MFY is giving negative 11.185% return. MFZ is given 15% return. Best is MFZ. Best is MFZ. Period of holding is 300 days, 124 days, and 195 days. Past returns are likely to continue in future. So you are giving me a very good indication saying that MFX and Y is useless. MFZ is the best. MFZ is the best. Mutual fund is charging an exit load of 5% if you redeem within 1 year. If you redeem within 1 year, what action would you take in MFX and MFY? You need to take an action in MFX and MFY. MFX is giving how much return? 9.733. So listen, understand the calculation only, understand the MCQ. We'll see this in a problem later. MFX is giving 9.733. If I want shift this to MFY, sorry, MFZ, shift this to MFZ, Z will give me how much return? Extra how much? Gap is how much? 5 point for 1 year. This extra is for 1 year. Return is normally annualized return. Return is normally annualized return. I think the question does talk about annualized return. So if you shift, you earn extra 5.267% for 1 year. How much is the exit load? 5%. And listen. How much is our investment already? So if I wait for another 65 days, I will lose something. But save 5%. What will I lose is 5.267 into 65 by 365. This is my loss. If you don't shift, your loss is 5.267 into 65 by 365. But what will you save? 5% exit load. What will you save is 5% exit load. What is this number? 5.267 into 65. Point. MFX I'm not going to exit. I will wait for another 65 days. Lose 0.93%. I'm okay with it. Wait for 65 days. Then shift to MFZ. Why are you waiting for another 65 days? Because you are already holding for 300 days. If you hold for another 65 days, exit load is out of the scene. In another 65 days, what is your loss? Your loss is 5.267 for 1 year. That is not for 65 days. So for 65 days, your loss is only 0.93. You are happy to lose this. Able to understand the calculation? Because it makes sense for me to have lower return. This is, I'm doing a cost benefit analysis. I am okay with the lower return. Clear? Able to understand this? Second situation. This guy we are at minus 11.185. This is way big headache. Minus 11.185. I can shift this to MFZ, which will give me 15%. Extra how much? Extra 26.185%. From negative you are moving to positive. Extra for 1 year. What is the period of investment as of now here? 124. Wait for another how much? 241 days. Can you wait for another 241 or not? I have to take a call. Wait for another 241 days. Another 241 days means I will lose 26.185 into 241 by 365. I will lose this much. and save what? 5% exit load. I don't want to save exit load. I don't want to save exit load. I'm okay to incur the exit load and close this and move to the other mutual fund. Move to the other mutual fund. Understand the difference. Able to understand the difference. There is some error in the solution. I remember. Just give me a minute. Just do one thing alone. This is 195 and this is 124. I remember some error is there. 195 and 124 is not going to make any difference on the conclusion. Why I talked about? Because I've done the return loss for 170 days. The return loss is calculated for 170 days because you have already hold for 195. Another 170 can you hold? Another 170 can you hold is what we are analyzing. Net conclusion is redeem MFY and don't redeem MFX. Don't redeem MFX. I am saying I'm okay with lower return. I'm okay with exit load. I'm okay with exit load in mutual fund Y. And I'm not okay with exit load in mutual fund X. In mutual fund X, I will wait, save 5% and have a lower return. Have a lower return. MFY doesn't make any sense. MFY doesn't. Assume the question does not give exit load. This happened in the recent exam. Simple answer. Close MFY, close MFX and shift everything to MFZ. Shift everything to MFZ. They asked in the recent exam this. What conclusion do you want to give or what is your advice to the investor? I don't want to continue with mutual fund X. I don't want to continue with mutual fund Y. I'll shift everything to mutual fund Z because that is giving me the highest return. And you are saying what happened in the past will continue. What happened in the past will continue. Clear? Any doubts on this? Can we proceed? So let's first understand what is NAV. NAV of a mutual fund is nothing but the fair value of assets minus the value of liability divided by the number of units. So whatever assets a mutual fund has, you need to value them as per their current market price. You cannot go by the historical data, go by the current market price, value the mutual fund, value the various assets and liabilities they have and divide that by the number of units. Understand very clearly that number of units of a mutual fund and something called as number of shares has no linkage. The both are separate things because some students are under the assumption that if a mutual fund buys more shares, the number of units will go up. No, that is no linkage. Units is on the liability side of the mutual fund balance sheet and shares is on the asset side of the mutual fund balance sheet because shares is bought by the mutual fund from some other company and units is issued by the mutual fund to the MF investor. To the MF investor, he is going to issue units. So units is what will come in our denominator calculation. So market value of assets minus the value of liability divided by number of units. In assets, we have multiple assets like equity investment, debt investment, money market investment, cash balance, receivables, other assets. We can have multiple items which are there. Now there can be a situation where question does not give you the details of the assets. You wanted the details of the assets, but the question has not given you the assets detail. Then what I can do is there is a opening net worth. What is opening net worth is this. The gap between this is called net worth. There is a opening net worth. You have assets and you deduct liabilities, you'll get an opening net worth. So you had your opening net worth. The net worth goes up because of certain reasons, goes down because of certain reason. When does it go up? If you earn any income, if you earn any capital gain. When does it go down? If you incur any expenses, if you pay out any dividend, wherever there is an outflow, it's an expense, net worth will go down. Wherever there is an inflow, net worth will go up. Along with that, the net worth can increase. Net worth can increase if new investors are coming into mutual fund. Any new guy coming into the mutual fund will increase the net worth of the mutual fund or net asset value of the mutual fund. And anybody is going out will decrease. Anybody going out will decrease. So in case you do not have the asset detail, then what you can do is start with opening net worth, add items which are going to increase the net worth, deduct items which are going to reduce the net worth, and denominator is opening units. If you have allotted any new units, add them and deduct any units which have been redeemed by the investor. Redemptions and new purchase will keep happening in the practical world. So any redemption happening or a new purchase happening needs to be factored in the calculation. Example, I had 1 lakh units on day 0 with an NAV of 50, which means opening net worth is 50 lakh. Opening net worth is 50 lakh. New units got allotted on day 60. Day 60, 20,000 into 60. 20,000 into 60. So net worth has gone up. Net worth has gone up. Portfolio appreciation. Net worth has gone up. Portfolio appreciation. Net worth has gone up. Units redeemed. If you redeem units, net worth will go down. If you redeem units, net worth will go down. This dividend payout I'll explain later. Dividend payout I'll explain later. So we had opening net worth of 50 lakh. There's a fresh allotment of 12 lakh. Portfolio appreciation of 60 lakh. There's a redemption of 12 lakh. In case you are not having details of assets and liability, you will have to track it like this. You will have to track it like this. So my closing value is this. This is the closing units. And then there is a NAV before dividend. NAV before dividend. Whenever a mutual fund declares dividend, NAV will fall by the amount of dividend. Whenever a mutual fund declares dividend, NAV will fall by the amount of dividend, whether paid or not. Whether paid or not. Because the formula is market value of assets minus the value of liability. Market value of assets minus the value of liability. Now what happens because of this formula is, if you declare dividend, liabilities increase. If you declare dividend, liabilities increase. And you declare and immediately paid, cash goes down, assets go down. Cash goes down, assets go down. So in effect, if dividend is paid by a mutual fund, you will see a drop in their NAV. You will see a drop in their NAV. So NAV will go down because post dividend they've asked. So 100 will go down to 99. 100 will go down to 99. Clear? Any doubts on this? Now on the NAV, if anybody is coming in or going out on that date, I'm just talking about that specific date. Today morning we had 1 lakh units, NAV is 90. Some extra 10,000 people are coming in at same 90. Overall will become 1,10,000 into 90. NAV will not change. NAV will not change. When will then NAV change? NAV can change when there is a change in the value of underlying asset or liability. When there is a change in the value of underlying asset or liability. Just because a person is coming in or a person is going out, that cannot lead to any change in the NAV of a mutual fund. That cannot lead to any change in the NAV. Now you may have a doubt that why is this considered in the calculation? That is not on that day. This happened in some time back. If today you are doing calculation, today you are entering in morning 1 lakh into 90, not morning, in fact, NAV is calculated at the end of the day. NAV is calculated at the end of the day. So how NAV is calculated is, they don't even consider inflow and outflow. They calculate NAV and then they say, I will allot extra units at this NAV. I'll allot extra units at this NAV. So anybody coming in or going out cannot change NAV. Anybody coming in or going out cannot change NAV. These are very, very important concepts. You'll understand the importance of it as we proceed. If you declare any dividend, this I've already explained, NAV will fall by the amount of dividend. Now, in our asset side, one major asset is cash balance. One major asset is cash balance. The amount could be insignificant, but that is one of the item in the asset. Some question cash is directly given. Please take it. Some question they have given opening cash. They have given opening cash and they are saying cash is coming in, cash is going out, cash is coming in, cash is going out. You have to prepare a cash account. You have to prepare a cash account or a cash statement, whatever you want to do, and calculate the closing cash. Calculate the closing cash. Closing cash given, no problem. Directly take it. Opening cash given. There was one problem where they gave opening cash and they gave only one expense called as expenses paid. Expenses paid. Opening cash minus expenses paid, closing cash. Another attempt, ICAI gave expenses paid and they gave the closing cash directly. They gave the closing cash directly. Now student keep asking me, why are we not deducting the expenses? Why will I deduct the expenses when the closing cash is directly given? Expenses paid, if data is there in the question and closing cash is there, that is of no use in NAV calculation. Why no use? Because my NAV is asset minus liability. Expense is neither asset nor liability. Expenses paid. Unpaid, NAV will get impacted. Unpaid, NAV will get impacted. If expenses have already been paid, cash would have automatically gone down. Cash would have automatically gone down. NAV would get impacted. But when I do my calculation, expenses paid is of no use. Expenses paid is of no use unless for this purpose. Start with opening cash, add inflows, deduct expenses, and get your closing cash. Get your closing cash. Now, when I was talking about NAV, I said we'll have to do valuation. We'll have to do valuation. Now, how are we going to do valuation? The question will say when you purchased Nifty is at 20,000. When you are selling Nifty is at 24,000. So what we are going to do is when I purchase 20,000 is equal to 100 lakh. When I sold 24,000 is equal to question mark. Just approximate calculation. These are just approximate calculation. So amount invested into the closing index value, divided by the index value on the date of investment, Is this exact right calculation? No, this is just an approximate calculation. Why are we doing approximate calculation? You have not given me information. I'll have to do approx calculation. Sometimes there could be a bond valuation which is needed. You'll learn about bond valuation when I do this. But for bond, the simple formula is interest divided by current yield. This is the formula to value a bond. Interest which you pay divided by the current yield. But we'll learn this in bond valuation. Just an example. Equity shares were purchased when index was 1000. Amount of shares purchased is 20 lakh. Index value on the NAV valuation date is, if you just leave it till this, okay, this is what exam will do. I added extra complexity there. If you just leave it till this, 20 lakh equal to 1000, question mark equal to 1500. 20 lakh is equal to 1000, question mark is equal to 1500. But what complexity I said is, what will be the value of share if underlying shares have appreciated at double the rate of index appreciation? Double the rate. Index from 1000 to 1500 is how much increase? 50%. My shares is double of 50%. This is an extra addition I have done. Otherwise, 50% only for my share also. 50% only for my shares also. I have added saying that we have appreciated at double the rate of index. Clear? Any doubts on this? Value of listed bonds, 20 crores. Face value is 15 crores. Acquisition cost is 20 crore. That is, it is a 15 crore bond. I paid 20 crores. Market expectation on listed bonds is what? 7%. Market wants only 7% return. So, bond value is very simple. Interest divided by investor yield or current yield. What will the interest bond pay? 14% on face value or cost of acquisition? On face value. It will pay only on face value. So, interest is 15 crore into 14%. 15 crore into 14%. Logic for this formula I will discuss in bond valuation. Divide this by 7%. This will give you the bond valuation. Bond value. Clear? Any doubts till this? Okay, let me close the balance part also. This segment of the concept, let me quickly close it. Dividend out of realized earning. Let me first explain what is dividend out of realized earning. Some question will say that the mutual fund went ahead and paid a dividend of 20% of what it earned. A mutual fund earns three things. One is dividend or interest. Second is realized capital gain. Third is unrealized capital gain. If they are saying dividend is paid out of realized earning, which means realized capital gain also has to be considered in the calculation. If you have paid dividend out of realized earning, what is realized earning? Is a mutual fund earns three things. One is dividend or interest. Second is realized capital. What is realized? You have sold the share. What is unrealized capital gain is, you said you are not selling it now. So on 31st March, you are adamant that you won't sell. The mutual fund is saying, I am not going to sell this. I'll sell it later. That's the whatever the mutual fund wants to do. We are not getting into that. So unrealized capital gain will not be considered. Example, a mutual fund sold shares worth 80 lakh for 88. 8 lakh profit. It sold another lot worth 75 lakh for 72. Loss of 3 lakh. So 8 minus 3, 5 lakh is realized capital gain till now. Income of 4 lakh, which is realized dividend. It has decided to distribute 60% of realized earning. ICAI added this in a question. Student by mistake took 60% of 4 lakh. Took 60% of 4 lakh. They thought realized means only income. They thought realized means only income. But realized means dividend as well as capital gain. Dividend as well as capital gain. Clear? Any doubts on this? Can you proceed? Okay, next concept got tested in one question. This is not a mutual fund concept. The dividend income which you calculate is on face value, which is true. The dividend income is on face value. Now, what ICAI did in one question is, they said you have 20,000 shares. There is a bonus issue made and a dividend is paid. There is a bonus issue made and a dividend is paid. Now, the student is under a headache. Whether should I take on 20,000 share or on 25,000? Because post bonus it will become 25,000. Post bonus it will become 25,000. Before bonus it is 20. This is from income. I'm not talking about mutual fund distribution. I'm talking about the income of the mutual fund. So they asked this question where there are 20,000 shares you have purchased, and on one fine day they declared bonus as well as they have declared a dividend. They have declared a dividend. Now the confusion is, should I take it on 20,000 or should I take it on 25,000? Example, a mutual fund has invested in 10,000 shares of XYZ Limited. XYZ in its AGM declared dividend of 10% on face value, 10% on face value, and a bonus of 1:10 with the record date being 28th December 2021. These are exact wordings copied from that question. I've just exactly copied it. Numbers I could have changed. What is the dividend received by MF from XYZ Limited? Because that is needed to calculate the closing cash. That was needed to calculate the closing cash. Now the headache for student is, should I take it on 10,000 or I take it on 10,000 plus another 1/10? Another 1/10. So do I take it on 10,000 shares or on 11,000 shares? If dividend and bonus is happening on the same date, dividend will only be paid on the earlier shares. Dividend will only be paid on the earlier shares. However, in the event of dividend declaration prior to the bonus date, the dividend income will be applicable only on the original shares held by the mutual fund and not the newly allocated share. This became a little bit of a concern for the student when he was doing it in exam. Clear? Able to understand this? Next, in mutual fund NAV calculation, you will see a problem where they'll give some cash component and equity component. They'll say NAV is so much. This includes cash of so much, equity part of so much. Cash will increase or decrease based on inflow or outflow of cash. Based on inflow or outflow of cash. Equity component will increase or decrease based on the market. Based on the market. So, if market, which is Nifty, increases by 10%, my mutual fund may increase by even 14-15%. That depends on something called as beta. That depends on beta. We'll understand this more in portfolio management. But beta basically measures this relationship. So, if beta is 2 times, market increases by 10%, our security will increase by 20%. Opposite, market decreases by 10%, our security will decrease by 20%. So, increase as well as decrease, it's going to be significantly higher than what is happening with the market. So, cash component will decline by expense per unit, whatever expenses we are incurring. Equity component will change based on movement of market. Beta can be used to find the percentage change in equity component. Beta into percentage change in market. Example, I have an NAV of 25, in which 90% is equity, cash is balance 10%. So, the 25 breakup is 22.5 is equity, 2.5 is cash. Annual expense is 4 rupees. Annual expenses 4 rupees. We are doing the NAV at the end of 3 months. So, in 1 year, you are incurring 4 rupees per unit. In 3 months, we will incur 1 rupee. 1 rupee. So, the cash from 2.5 will go down to, provided no other income is there, it will go down to 1.5. And the share market has declined by how much? And our beta is, so we will decline by 12%. We will decline by 12%. So 22.5 will decline by 12%. Cash will decline by 1 rupee. And netted NAV from 25 will go down to 21.3. This is also one another way of calculating NAV, where they'll say how much is the cash component and how much is the stock component. Stock component will change based on the market movement. Cash component will change based on the expenses we are going to incur. Dividend equalization, I said I'm not doing it. I told you to look at a problem for this, but I'll just broadly only say what is dividend equalization. Practically, mutual fund calculates NAV on a daily basis. That is what practical world. ICAI has asked some exam question where the NAV is calculated once a quarter. They did not give NAV every month. So then I have the NAV of April 1. Now, April 30, someone is coming in. April 30, someone is coming in. I cannot get the April 1 NAV from him. I cannot get the April 1 NAV. So, approximately what I'll get is I'll get the April 1 NAV plus in the month of April, the MF would have earned some income. The MF would have earned some income. That's an approximate increase in NAV. That's the approximate increase in NAV. So, whatever income I earned in April, I will tell the new guy to contribute for that also, because moment he comes in, he becomes a part owner of entire income. He becomes a part owner of the income which is there even before he came in, because he becomes an owner of the mutual fund. A mutual fund earns income periodically. However, if the NAV is not computed periodically, then there will be a need to adjust NAV to the extent of dividend equalization. Which is total income earned divided by number of units. If you are coming in, you have to bring in dividend equalization. If you are going out, we will give you dividend equalization and tell you to go out. We will give you dividend equalization and tell you to go out. Logic is simple, because when you came in, the funds have already earned, so you contribute. When you are going out, you cannot earn this, or you cannot share this income. So we are saying, if you are going out, please take this money and go. So issue price is opening NAV, add dividend equalization, add entry load. Exit price is opening NAV, add dividend equalization. I'll give you the dividend equalization and deduct the exit load. Equalization is received from MF investor. Similarly, equalization is paid to MF investor. It is paid to MF investor. There's one problem. You can see the video and all. That is something you can manage. Related question is this income available for distribution. Okay. A mutual fund has one important element called expense ratio. We learned initial expense ratio. We also learned annual expense ratio. So expense ratio is one critical item in a mutual fund, and any increase in expense ratio will take away my returns. My return is significantly dependent on expense ratio. So how do we calculate this expense ratios? We have multiple ways. One, you can put overall expenses divide by overall NAV, or you can do expense per unit. You can divide by opening NAV, you can divide by closing NAV, or you can divide by average. Average is better. Just to give an example, annual expense 20 lakh. Number of units 1 crore. Number of units is 1 crore. So expense per unit is 20 paise. NAV on the closing date is 20. So I have only closing NAV in this example. 0.20 divided by 20 rupees. 0.20 is per unit, 20 also per unit. 0.20 is per unit, 20 also per unit, into 100 to express in percentage. This question I am not doing it. So I had told one question is pending. This is question 22, which you can attempt at home. That includes this expense ratio calculation. That involves this expense ratio computation. Then comes your performance evaluation. We have broadly 3 ways of performance evaluation. Okay, one is called Sharpe ratio, second is called Traynor ratio, third is called Jensen's alpha. These are the 3 ways of evaluating the performance of a mutual fund. Sharpe, the term Sharpe is otherwise called as reward to variability. Very clear. Let me explain this in detail. Why it's called reward to variabilities? Variability is associated with standard deviation. You will learn this in portfolio. Standard deviation measures the variability of return. Beta measures the volatility of return. Standard deviation measures the variability of return. Beta measures the volatility of return. When I'm going to do certain question, they'll tell you to calculate beta. Some formula will be there. I'll not do all that part. That is portfolio. How to calculate beta is portfolio management. How to calculate standard deviation is portfolio management. Here, assuming you give me everything directly, I'll calculate Sharpe ratio, Traynor ratio, and then give a conclusion. Now, just To remember, some of you may get confused or have a doubt. SS, you can just remember this. Sharpe ratio, denominator is standard deviation. SS, just for your remembering purpose. Sharpe denominator is standard deviation. Standard deviation is for undiversified portfolio. Standard deviation is for undiversified portfolio. You learn this in portfolio chapter. You learn this in portfolio chapter. Trainor is for diversified portfolio where the denominator is beta. Where the denominator is beta. Sharpe, standard deviation. Trainor, beta. The formula is excess return. Excess return divided by standard deviation or divided by what is excess return? Excess of risk-free rate. Excess of risk-free rate. Whatever is the risk-free rate, how much extra are you earning? How much extra are you earning? That extra is the numerator, which can be, yeah. See, the term can be expected return, the term can be actual return, the term can be required return. You can keep, see, basically, this is the return the mutual fund is giving. Expected to give, R is giving. Expected to give, R is giving minus the risk-free rate divided by standard deviation or beta. Example, Sharpe ratio 1.5, 1.65, 1.25. Trainor 8, 9, 10. Above ones are what? Which ratio is useful? Undiversified. Sharpe. Rank the above funds. Which is the best Sharpe ratio? B. Next one. A. Next one. C. So B, A and C is the ranking. B, A and C is the ranking. Higher the better. Higher the better. Alpha is nothing but you have the CAPM formula. RF plus beta into RM minus RF. If you generate anything in excess of this, if you generate anything in excess of this, that is called alpha. If you generate anything extra to this, that is called alpha, which can be positive or negative. It can be positive or negative. Risk-free rate is 10%. Beta is one time. Beta is one time. Jensen's alpha of mutual fund A is 4%. Market return 14%. SD of MFA 10%. What is reward to volatility? I've linked all the three. I've linked all the three. Reward to volatility, that is all the three metric, some data is there. First, what is the formula for reward to volatility? Excess return divided by beta. So for excess return, I need the actual return minus the risk-free return, or the return expected to earn. So first thing is I'll apply the CAPM formula. The CAPM formula will give me required return. Actual is 4% more than the required. Actual is 4% more than the required. Excellent MCQ. It tests everything. It tests everything. You are earning 4% more than what you should earn. You are earning 4% more than what you should earn. What you should earn is RF plus beta into RM minus RF. Tell me what you should earn. RF plus beta into RM minus RF. 10, 1 into, so you should earn 14%. You're actually earning 18. You're actually earning 18. You should earn only 14%. You're actually earning how much? 18. 18 minus risk-free is how much? 10 divided by beta. Divided by beta. So 18 minus 10, reward to volatility is 8 times. Reward to volatility is 8 times. It is linking everything. It is linking all the three metric. Alpha calculation is very simple. What you should generate compared with what you are generating. What you should generate compared with what you are generating. Then MF performance evaluation, negative value. This is not a concept and all. In one exam question, ICAI, unfortunately, whether they wanted to test or was there a mistake, all the values became negative. Sharpe, Trainor, everything became negative. Reason is risk-free was 10% and mutual funds were giving 4, 5, 6%. So student got a lot confused. They were thinking that something is wrong with the question. So many did not proceed. Many did not proceed, but that was a right question only. These values can be negative also. These values can be negative. Negative indicates means the mutual funds are doing bad. Mutual funds are doing extremely poor. That is why you are having negative Sharpe, negative Trainor. Alpha though can be negative. Alpha though 100% can be negative, but Sharpe, Trainor negative is very rare because at least risk-free you have to earn. At least risk-free you have to earn, but there can be a situation where you can get negative. tracking error. I have not done a question on this even in my regular class, but it was there in some part of the ICAI material. So I'll discuss what is tracking error first. There are two types of mutual funds. One is called active mutual fund. Second is called passive mutual fund. Active mutual fund means the MFY will keep buying, selling. Passive means they buy as per one index. Nifty is there. Nifty has 50 shares. Sorry, Nifty has 30 shares. So what people will do is there's a mutual fund called SBI Nifty MF. This mutual fund will invest in these 30 companies. In these 30 companies, if somebody gives money, again he'll put in the same ratio in the 30 companies. He'll keep buying 30 companies, keep selling 30 companies. If somebody wants money, he will sell the share and give the money. If somebody puts the money, he'll put it in these 30 companies. So ideally, the return of Nifty and the return of this mutual fund should be same. The return of the Nifty and return of the mutual fund should be very close to each other. Some difference can be there because of expenses. That difference is measured through tracking error. The difference is measured through tracking error. How much are you deviating? How much are you deviating from your benchmark? How much are you deviating? Tracking error is the deviation of a security return as compared to a benchmark return. Standard deviation is calculated. How you calculate standard deviation? Portfolio chapter. How you calculate standard deviation? If you remember, probability, return, probability, product deviation, PD square, something like that we used to do. So the same concept we are going to do here. So you are going to use the concept of standard deviation but without probability, without using the term probability. For example, 4, 3.7. The deviation is 0.3. The deviation is 0.3. Then 2, 2.5, the deviation is minus 0.5. So like this, you will have to calculate the deviation. After the deviation is calculated, the standard deviation of the deviation, because I don't want it to deviate from that index. I don't want this to deviate from the index. I'm not calculating standard deviation for this. I'm not calculating standard deviation for this. I'm calculating standard deviation for the difference. First, you calculate the difference, which is this. For this, you will have to calculate standard deviation for this number. So the average is, the total is minus 0.6. Then you calculate deviation. What is deviation? Is minus 0.6 minus, sorry, 0.3 minus of minus 0.6. Then you do a square of this and ultimately we divide by n minus 1. This is a very important concept that ICAI has never covered in material. See, the denominator for calculating standard deviation can be two things. One is called n minus 1. Another one is called n. This depends on the data we have. This is a statistics concept. What statistics says is, if you have entire data, that is, if you have 1000 years data and you are using 1000 years data to calculate standard deviation, then you can go ahead and divide by n. But when you're randomly picking some 4 years data or 5 years data, there is a possibility that you have picked up wrong data to calculate the error. You have picked up the wrong data to calculate the standard deviation. To avoid this error, they say you have to divide by n minus 1. Let's not get much into it, but ICAI material in tracking error alone has done n minus 1. They have done n minus 1. You follow that in exam, if at all it comes, because they may end up asking something from the, because this example is there in the ICAI material. This example is there in the ICAI material. So this is a tracking error calculation. How to do standard deviation all there. How to do standard deviation, we'll see it there. We've discussed this extensively. In case you want me to discuss anything, let me know, else I move to the next chapter. If you still want something to be discussed, let me know. Again, I'll repeat, if now I want to revise, I'll show you one chapter revision for you. I'll just show you one chapter revision. You'll be able to appreciate this better. We are at 9:39, sorry, 3:39. It will take me exact 10 minutes to revise this entirely, because every concept I've explained to you, and if I read the concept book, things will automatically become clearer. First concept, what is mutual fund return versus own return? Tell me, participate with me. Own MF return is equal to own return divided by 1 minus initial expense ratio plus annual expense ratio. Second concept, there can be an opportunity cost when you're making your own investment. When you're making your own investment, what is the opportunity cost? Loss in my professional income. Loss in my professional income. What is the disadvantage of giving to mutual fund? He may generate lower return. So compare the lower return with your opportunity cost and decide whether there is a net gain or a net loss. Third concept, holding period return versus annual return. The formula is what I get back minus what I give divided by what I give into 12 by m into 100. NAV1 minus NAV0 plus D1 plus CG1 divided by NAV0 into 12 by m into 100. If you don't do into 12 by m, you get the holding period return. If you do into 12 by m, you get the annual return. Fourth concept, Return for close-ended scheme. Close-ended scheme is something which is not traded in the market. Because it's not traded in the market, its NAV can be at discount or can be at premium. So if it's at discount or premium, consider that as NAV1 and NAV0 and apply the formula. Consider that as NAV1, NAV0 and then go ahead and apply the formula. Fifth concept, return computation. Wherever date of investment is available and you are doing calculation for lesser than a year, it is preferable to do the calculation in days rather than in months. Also, for your number of days calculation, date of investment can be ignored in the calculation. Total yield of investor. A mutual fund may invest in, an investor may invest in multiple mutual fund. So MF1, MF2, MF3, put a total column. Total investment, total dividend, total capital gain, total return, divide by the total investment will give you the annualized return or the total, will give you the total return of the investor. Period of holding can be calculated by comparing your holding period return with the annualized return. Annualized return equal to 365 days, holding period return is equal to question mark, and you get your period of holding. Next concept, dividend payout versus dividend reinvestment. Dividend payout, NAV1 minus NAV0 plus D1 plus CG1. Dividend reinvestment, your opening units and closing units is not going to match. So we are using a formula called as closing value minus the opening value. What is closing value? Closing units into closing NAV. What is opening value? Opening units into opening NAV. Divide by your investment into 12 by M or not 12 by M, depending on what you are calculating, into 100. Next concept, for calculating your closing units in a dividend reinvestment plan, I start with date, opening units, dividend in percentage, dividend in rupees, then there is an NAV which is there, you get dividend in units, you get the closing NAV. If you are doing your bonus plan, you're starting with the date, opening units, there's a bonus ratio, bonus units, and you get your closing units. Taxation impact. As far as taxation is concerned, cost of acquisition of bonus units is 0. Securities transaction tax is not allowed as tax deductible expense. And for your dividend reinvestment plan, cost of acquisition is the NAV on the date of dividend reinvestment. For dividend reinvestment plan, effective yield, this is not a concept which is needed. That is calculating yield through IRR approach. Calculating yield. Front end load is entry load added to your opening NAV or added to your NAV. Back end load is exit load deducted from your NAV. So formula is very simple. Front end load is equal to what price I pay minus the NAV divided by the NAV. I'll divide by NAV itself, and this is NAV minus redemption price. Again, I'll divide by NAV. Exit load versus lower return from mutual fund. Sometimes I'm okay to continue with the lower return from a mutual fund because of this issue of exit load. So I'll have to compare what is my loss in return and compare with the exit load. If the loss in return is lesser than the exit load, please continue with the fund. If the loss in return is more, exit from the fund and pay off the exit load. Pay the exit load. Net asset value. Net asset value is equal to value of all assets minus value of all liability divided by number of units. All assets will be valued as per market value. No accounting concept here. Value of liabilities will be taken, whatever liabilities are there in the question. In this calculation, sometimes they may not give you the detailed assets. So there is an opening net worth, add extra items which is adding to the net worth, items increasing the net worth, deduct items reducing the net worth, and divide by closing units. Divide by closing units. Then if anybody is coming into the mutual fund or if anybody is going out of the mutual fund, NAV is not going to be impacted. You are coming in, NAV will remain same. You are going out, NAV is going to remain same. Impact of dividend declaration. Once dividend is declared, NAV will fall by the amount of dividend, and thereafter only reinvestment will happen. Thereafter only reinvestment will happen. So your reinvestment will happen at lower NAV, which is post dividend fall, post the fall. Cash balance computation. Some question, if cash balance is not given, please prepare a cash statement so that you're able to get your closing cash and add that closing cash in your NAV calculation. Valuation of equity share. Equity share valuation, I'll do it based on the index valuation. On the date I purchased, there was an index value. On the date I'm doing a valuation, there's an index value. Compare that and I get the value. Bond valuation, logic I'll explain later, but the value of bond is equal to interest paid divided by the current yield. Interest paid by the current yield. Dividend out of realized earnings. The term realized earnings does not mean only the dividends earned. It is dividend, interest, and realized capital gain. You will have to consider realized capital gain also in the calculation. Dividend income on equity share. What is dividend income on equity shares? Is in case I have made my investment and there's a bonus which is paid as well as dividend which is paid, my dividend income is going to come only on the original shares and not on the bonus share, not on the bonus shares. Mutual fund can have two components. There is a cash component, there is a equity component. Cash component will go up or go down based on what is happening to your expenses. Equity component will go up or go down depending on what is happening to the market. Market may fall by 10%, our portfolio may fall by more than 10% depending on the beta. Impact of dividend equalization. If you are coming in, please bring dividend equalization. If you are going out, please take out dividend equalization and go. So coming in, you'll have to bring extra. Going out, take the dividend equalization and go out of the fund. Expense ratio, which is expense per unit divided by opening NAV or closing NAV or average NAV. For performance evaluation, I have three ratios: Sharpe, Traynor and Jensen. Sharpe ratio is nothing but excess return which you are generating divided by the standard deviation. Sharpe standard deviation, SS. Sharpe is otherwise called as reward to variability. Reward to variability. Traynor is otherwise called as reward to volatility, for which I am going to use a denominator called beta. I am going to use a denominator called beta. This Sharpe is useful for undiversified portfolio. Traynor is useful for diversified portfolio. Both higher the better. They can be negative as well. They can be negative. Alpha is equal to the actual return which you are generating compared with the required return as per CAPM. You can have positive alpha. You can have negative alpha. Tracking error, this is applicable for passive mutual funds. Tracking error may come for a mutual funds like an index mutual fund. You have your return, you have the Nifty return. Look at the difference in the return. So for calculating standard deviation, this is not useful, this is not useful, this is what is useful. The differential return, take an average of the differential return, get the deviation, do a square of it, no probability, and divide by n minus 1, divide by n minus 1. Exactly took me 7 minutes to revise the chapter. Exactly took me 7 minutes. I started at 3:39. We're done with 3:46. This is what concept book is going to do, provided you have clarity on the concept. I may go at 7 minutes, you may go at 30 minutes. That's okay. But this is the amount of time it is going to take for you to revise the chapter, provided clarity on the concepts is there. Clear? Anything you want me to discuss in mutual fund, let me know. Else I move ahead. Anything still needed, let me know.